Today we're analyzing FMC Corporation, ticker FMC. Over the next few minutes, I'll discuss my thoughts on both the business quality and its overall valuation. Market cap is $16.2 billion, enterprise value $18.4. You see about $2 billion in net debt, about 10% of the enterprise value, not an unreasonable amount. You're operating in the chemicals industry. FMC Corporation apparently operates agricultural sciences, crop protection, plant health, professional puff and turf management services. So it markets and sells crop protection chemicals like insecticides, herbicides, fungicides. Tells you a good amount there. Has its own sales organization, independent distributors, and sales reps. Operates all around the world. Founded in 1883. Okay, so beta of 0.86, not very significant. Share turnover, not very significant there. Return on invested capital. First thing that leaps out to me is two things: cyclicality and profitable every year. I love to see companies that are profitable each and every year. That's a good marker for a high quality business. Their low looks like it was in 2003 of 1.51% invested capital. They had another low in 2016 of 5%. Otherwise, they tend to be hovering around this 10% line, which is exactly what I want to see in a business that I like to invest in, is something that's either the 10% line or higher. And in general, they're averaging about that 10% number. You do get some really high numbers in the 17% range at the top of these cycles, but you're definitely cycling every 3 or 4 years. This looks like a cyclical company. Your overall 10-year median returns, 9.3%, pretty reasonable. Return on equity of 19.7%, very good number there. Again, I want this number to be above 15%. 10% is a good target for return on invested capital. In that 10 to 15% range, you're in a really good range for overall returns. An important thing about having this return on equity very high is you can self-fund all your growth, and it does look like they're able to do that as their return on equity exceeds all of their growth CAGRs. Now, free cash flow is going really nicely at 12%, but I'm really going to hone in on the EPS here at 6.8%. Let's call it 7. Revenue of 5.5% there. Now, assets are growing faster than revenue, which would normally suggest to me that EPS would grow even slower, but somehow they're outgrowing that with their free cash flow number. We might have to do a little bit of a deeper dive there. But overall, we're talking about 5 to 7% return in terms of your growth return. And they're trading at a PE of 22, so you have an earnings yield of about 4.5%, 4 to 5% range. Yeah, 4.5% there in terms of your earnings yield. You add 5.5% on your revenue growth. You instantly start thinking about, okay, this is about a 10% returning business. Now, maybe you can get some dividends on top of that, which it looks like they do have here. So let's do a quick look at their dividend yield. Trading about $2 there in dividends. Maybe a 2% earnings yield. So now you're talking about you have potential for like a 10 to 12% return for this investment. That starts to get really interesting when you can hit that mark. You're on the 10%, the low range, you get that 4.5% yield, 5.5% growth. 10 to 12% then is a possibility on your upper end. On the lower end, you start talking about maybe just getting the revenue of the 5.5% growth, and then you add your 2% yield. Maybe your low end return here is something like a 7.5%. So 7.5% to 12%, assuming you can repeat these sorts of growth rates, is a reasonable expectation for a company like this, and tends to be pretty normal. I think they're probably going to be prevented from hitting that higher 12% number just because cyclicality makes it a little hard. That's why you might have something on the lower end, but you do have some nice free cash flow growth rates where that does open up the possibility. One thing I note here when I look down at this gross profit margin is you did have a period of declines in revenue here from 2013 down to 2017, declined quite a bit. And then you had a 69% growth rate in 2018. So I'm assuming there's some sort of acquisition here that's just such a big jump to have otherwise, but does make me concerned that maybe some of the recent growth trends we have here aren't actually organic growth, because you do see that they had kind of declining revenue over a 3 to 4 year period, and then they were able to jump back up with potentially an acquisition. And organic growth is substantially better than inorganic growth, so it is something I'm just a little bit concerned about there. When we actually look at the EPS though, going from 216 to 581, that's a pretty good number, and to me would suggest actually your EPS growth is going a little faster than 6.8%. So a nice setup there on that side. We look over the last, 6, 7 years, and your return on equity is always above my little 15% target. There's only 1 year below in 2016 below that 15% target. So they're doing really well from a quality standpoint. Really the concern here is just going to be on growth and maybe that cyclicality playing a role into our overall thoughts on whether or not it's going to make it to my watch list by the end of this video. If you're enjoying this video so far, hit that like button. I'm going to continue adding some deep value here as we go into the income statement, balance sheet, and cash flow statement. So let's look at our income statement. Again, we see this gross profit decline, but again, a quick jump up in 2018. SG&A jumps up pretty significantly as well. So this, again, another sign that we probably made an acquisition in that time frame. You do see in 2017 a big hit from your income tax. That does suggest to me if this is probably the Tax Cut and Jobs Act of 2017 playing a role here in your one-time items, distorting this overall net income number. You do see a decline in shares outstanding over the course of the decade. It's not even a full 10%, but maybe we can give them credit for about 1% per year improvement in your EPS line from your buybacks. Now, that would make sense where you've gone from a 5.5% to a 6.5%, EPS growth, revenue growth to EPS growth. That tracks really well if we kind of give credit for about a 1% extra return due to our share buybacks. That's what you would see there on the EPS line. Go to our balance sheet. One thing that's really interesting right off the bat is you just look at this PP&E number, and you're basically flat over the course of the decade. At 2012, you had $956 million. 2021, you had $952 million. You did add assets, of course, in these years where it looks like this acquisition took place. 2017 timeframe, a couple $1 billion in goodwill and intangibles that made this big jump from $6 billion to $9 billion on your asset base. Some of your assets growing is, cash and accounts receivable. I try to ignore that as those working capital are a little less important as long as we're not talking about inventories, which does grow a little bit over time. You almost tripled your inventories. Long-term debt tripled from $900 million to $2.7 billion. Just a note is anytime the debt is growing faster than your revenue, faster than your UPS, it's not really a sustainable thing you can do long-term. None of these numbers are unreasonable, though, so I'm not really concerned about it. $2.7 billion in debt on this size of a business is not a major concern from what I can see. You do have some pension liabilities. They have been going down, so hopefully they've eliminated their pension. Pensions can be a big problem for some businesses. Okay. See what we can see in our cash flow statement. Something weird's happening with my 2022 data. First thing is, you're not putting a lot of money into PP&E, of course, with that declining over time. One of the ways that it happens is if you put in less money into your PP&E than your depreciation for a year, it's going to show a decline in your PP&E. And so that can happen for a few things. Maybe you don't need to invest as much, but maybe it could mean you're underinvesting. Either that could be a red flag, yellow flag, depending upon how you look at it. It could also be a good thing if you've, put the money in up front. You don't need to invest as much. That's also can be a really good sign. And of course, we see our two big acquisitions here, 2015, 2017. That we had seen and been signaled earlier, so we really know that's what that is. It does look like you took on your debt to match off with your acquisition purchase, which I'm totally fine with. That's a really good way to manage your debt. If you're not taking on debt just constantly to grow organically, but use that debt as an kind of one-time acquisition, and maybe you pay it down, maybe you do some different things. That's a good way to manage your balance sheet there. One of the things I note, you had that 1% improvement in your shares outstanding due to buybacks, but we can clearly see it's not happening every year. You had a 3-year period with no buybacks here, 4, 5. Some of this stuff doesn't really count. Your buybacks are coming intermittently, so it's not like you can rely on those buybacks in the future. Your return's really going to come from this cash paid for dividends. It looks like there was a big jump here as well. I need to go back here. Yeah, you had a big jump in your dividends from 2018 to 2019. I think that acquisition, it was probably just this idea that, hey, we have a much bigger business here. We can pay a bigger dividend. That's what you're seeing. But it is nice that they didn't have to dilute to accomplish that acquisition. So I like how that's set up. You can, if you're not diluting to grow, then you really can give some credit for those acquisitions in terms of your overall accounting for the business. But overall, my assessment for FMC Corporation is that it's a high quality to average business that's just not exceptional. It leans high quality. 20 straight years of profits is a good sign of high quality. You're hitting the metrics on your returns that I want to see, 10, 15, 20%. The reason it doesn't go on my watch list is the growth is just a little low. Like if you were growing at 10 to 15% a year and you maintained the exact same other metrics, the same cyclicality, the same valuation, the same, 10-year median returns and median margins, but you were hitting a 10 to 15% growth, this would hit my watch list. But with the growth that you have, I don't think it hits my watch list. The growth is just a little too low, and that growth that you have received has come in part from acquisitions. So for me, I'm going to pass on FMC Corporation because I have some concerns that they don't have the growth needed to really drive the double-digit returns that I want to see as a shareholder. They can certainly achieve it with the setup they have as a business, but I don't see that proof in their past, and so for that reason, I'm going to pass on it. I hope you've learned something from this video. Please hit that like button. Don't forget to subscribe. I'm working through every company in the S&P 500, and the favorite ones I've done so far are my watch list ones in this playlist above. I hope you'll check out that playlist where I have some of the best companies I've found that I think are worthy of some additional attention. So check that out. If you want to learn how to use software like this, quickfs.net is where you can find a link, is the first link in the description below. That's my affiliate link for QuickFS. Great way to support the channel is sign up for an account with them. Thank you for listening, and until next time, stop paying fees, start building wealth.